Imagine a crypto coin that never crashes, never skyrockets unpredictably, and stays locked to the dollar 24/7, 365 days a year. Welcome to the world of stablecoins. Whether you're trading crypto, sending money across the globe in seconds, or just looking for stability in volatile markets, this video is your gateway. Want to know the secret behind these coins and why they're exploding in popularity? Stick around, because you're about to discover the future of money. Hey everyone, welcome back to the Crypto IQ, where we break down crypto so anyone can understand it. Today, we're diving into a topic that sits right at the intersection of crypto and stability. Yep, we're talking about stablecoins. If you've ever wondered how stablecoins stay stable, what role they play in the crypto economy, or why they've become so essential, you're in the right place. Here's what we'll be covering. Chapter 1. What are stablecoins? Chapter 2. How stablecoins work: fiat-backed, crypto-backed, algorithmic. Chapter 3. Use cases and benefits. Chapter 4. Risks and controversies. Chapter 5. Stablecoins versus traditional fiat. Chapter 6. The future of stablecoins. Let's get into it, and make sure to hit that subscribe button if you're learning something new today. Let's begin with the basics. What is a stablecoin? A stablecoin is a type of cryptocurrency that is pegged to the value of a stable asset, usually a fiat currency like the US dollar. The goal is simple: reduce price volatility and make crypto more usable for everyday transactions. If Bitcoin is like a roller coaster, stablecoins are more like a flat road. Stablecoins aim to combine the best of both worlds: the speed and transparency of crypto, the reliability and predictability of fiat money. But not all stablecoins are created equal. There are a few key types, each with its own strengths and weaknesses. Let's break them down. There are three main types of stablecoins. 1. Fiat-backed stablecoins. These are the most common and easiest to understand. Each stablecoin is backed one-to-one by fiat currency held in reserve. For example, USDC, USD Coin, USDT, Tether, BUSD, Binance USD. That means for every one USDC in circulation, there should be $1 in a bank account somewhere. These are issued by centralized companies and require users to trust that the reserves actually exist. Pros: simple, reliable, highly liquid. Cons: centralized, subject to audits and regulation. 2. Crypto-backed stable coins. These are backed by other cryptocurrencies instead of fiat. One example is DAI, which is over-collateralized with ETH or other crypto assets. Because crypto prices are volatile, you might need to deposit $150 worth of ETH to mint $100 of DAI. Pros: decentralized, transparent. Cons: can become unstable during market crashes. 3. Algorithmic stablecoins. These use smart contracts and algorithms to control supply and demand. They aren't backed by fiat or crypto, but instead use incentives to maintain a peg. The most infamous example? Terra USD, UST, which collapsed in 2022. Algorithmic stablecoins are high risk and still an experimental part of the crypto world. Pros: fully decentralized and innovative. Cons: highly risky, vulnerable to collapse. So why are stablecoins such a big deal? 1. Trading pair. Anchor. Traders use stablecoins to quickly exit or enter positions without converting to fiat. 2. Cross-border payments. Sending USDC to someone across the world is faster and cheaper than using traditional wire services. Third, store of value in volatile markets. When crypto is crashing, stablecoins offer a temporary safe haven. 4th, DeFi integration. Most DeFi platforms use stablecoins for lending, borrowing, and liquidity pools. 5. Stable savings. In some countries with inflation, people use stablecoins like USDT as a more stable form of savings than their national currency. In short, stablecoins provide the reliability of fiat with the freedom and efficiency of crypto. Stablecoins solve a lot of problems, but they also come with significant risks and controversies you should know about. 1. Lack of transparency. Not all issuers are upfront about how much they hold in reserves. Tether, for instance, has faced criticism and legal scrutiny over its reserve disclosures. 2. Centralization. Fiat-backed stablecoins are typically managed by private companies. That means they can freeze funds, blacklist wallets, or be forced to comply with government regulations. 3rd, regulatory pressure. Governments are increasingly looking at stablecoins as potential threats to monetary control. This could lead to tighter rules or even bans in some jurisdictions. 4th, smart contract risk. Crypto-backed stablecoins like DAI rely on smart contracts to manage collateral. If those contracts are buggy or hacked, the system could fail. 5th, algorithmic collapses. We've already seen how fragile some algorithmic stablecoins can be. Terra USD's dramatic collapse wiped out billions and shook trust across the entire ecosystem. 6th, market contagion. If a major stablecoin like USDT or USDC were to depeg or fail, it could send shockwaves through every part of crypto, from exchanges to DeFi to NFT markets. These aren't just hypotheticals. Understanding these risks is essential for anyone using stablecoins, especially at scale. Let's zoom out for a moment and compare stablecoins to the traditional fiat system. Fiat money, like the US dollar or euro, is issued and controlled by central banks. It's legal tender, backed by national economies and accepted virtually everywhere. But it's also slow to move, often expensive to send internationally, and locked inside banking hours. Stablecoins, on the other hand, are available 24/7, including weekends and holidays, borderless and censorship-resistant, programmable, which means they can be used in smart contracts and automated systems. Transparent, on-chain balances can be audited in real time, but they're also not universally accepted in the real world, dependent on technology and internet access, vulnerable to platform or regulatory risk. So, while stablecoins offer flexibility and innovation, fiat still holds the crown when it comes to legal certainty and universal acceptance. The two systems are less rivals and more like complementary layers in a new financial future. So, where is this all heading? Let's talk about what's next for stable coins. First, regulation is coming. Expect more oversight on how reserves are managed, how audits are conducted, and how stablecoins are used in DeFi. This could increase trust, but also reduce decentralization. 2-point CBDCs on the rise. Central bank digital currencies like China's digital yuan are government's answer to stablecoins. These will have similar functionality, but with state control. The big question is, will users prefer decentralized options or regulated ones? Third, institutional adoption. Major financial players are increasingly using stablecoins for settlements and cross-border transfers. This trend could give stablecoins mainstream legitimacy. 4. More innovation in design. We're seeing new models that combine fiat crypto and algorithmic components in creative ways to reduce risk while increasing flexibility. 5. Use in real-world assets. Stablecoins could soon be backed by tokenized bonds, treasuries, or commodities, blending the traditional with the digital in entirely new ways. The future of stablecoins isn't just about holding value. It's about unlocking new types of economic activity. From microtransactions in games to instant global payroll, the use cases are just beginning. To sum it up, stablecoins are the bridge between the volatile world of crypto and the everyday practicality of traditional finance. understanding how they work, what backs them, and their potential impact is key to navigating the modern crypto ecosystem. If this helped clarify stablecoins for you, make sure to like the video, subscribe to the Crypto IQ, and drop a comment with your favorite use case or concerns. Check out our next video on how to use DeFi platforms safely, especially when interacting with stablecoins. Thanks for watching, and we'll see you in the next one.